Hello. Today, some analysts were surprised that gold has not rebounded. We want to show you that it was expected. We have been expecting this. It makes a good deal of time because we have always said that gold is not a hedge against inflation, as many says, but it's against real yields. And we want to show this today in this video idea. Here we have identified a trading range according to the week of method that by itself suggests that gold is going down to 1760. And we also see here that the most recent bottoms in the price were coinciding with bottoms in the RSI below 50, and in the RSI here in the monthly chart we are at 50, so we have still some length to go in the price. uh, the real yield is something debatable and hard to get, especially in to plot in the chart. So we chose to use here the market determined real yield, which would be the 10-year yield minus the break-even inflation on the 10-year bonds, which is the difference between constant maturity 10-year yield, fixed yield, and the other that's variable, which is determined a posteriori. And this difference in the yields is the inflation that the market is pricing in the bonds that of course reflects in the yields. So doing this right now, we can see this corresponding plot. And if we compare it with the gold chart, the same gold chart as before, just now as a comparison one does in black and white, and we invert the scale of the real yield, we see that they match very near one to the other. However, we can see here in March 2022, from that on, a divergence started opening between the curves, and especially here when gold pivoted on November, December last year. Then we have instead a pivot here in the real yields. We had a pullback, minor one, must be said. And then when gold made its peak, then the yields started again, resume their rising. I remind you that the scale is inverted. So here we are with the biggest divergence ever in the history of this chart. It started in early 2000s. So what to expect? The real yields to move back down, or being this chart here as it's plotted, the colorful one going up, or gold prices, the black and white, going down in the prices to catch up to real yields, perhaps both. So we believe that in the short term, and by that we mean the next few weeks, let's say at least the 2 to 4 weeks, we see gold prices going down, because that's the most natural and fast to respond of the assets. And inflation, at least as published by the government, it's a monthly data, and the markets might take a few time to react to it. Thus, we believe that in a few months, the real yields will go down. Thus, the colorful chart should go up. However, until then, the prices of gold should go down because they have the highest pressure down as this chart can impose ever. And because we are near the all-time highs, it's comprehensible that it will have a weight on its prices. Thus, we believe that gold prices are going down, perhaps to the bottom of that figure in 1760, as we see here this level, and perhaps a bit below, to the with a visit eventually short to the latest bottom at 1650, around that value. Uh, is it possible that we go beyond that? Well, that is speculation, and we will avoid that. Thank you very much for your attention. See you next.